So Tannor, Square or Palantir?
Tannor, don't make the wrong decision.
Dude,
Don't make the wrong
don't.
decision.
Please don't.
Because I will clip this and I will post it on my Twitter. Do not make the wrong decision, Tannor.
Do not make the wrong decision.
Do not say the wrong thing.
Like on a 12-month basis?
For a year, for 1 year.
For 1 year, okay.
I don't know. It's hard. I don't think
make a
this is
decision.
not something
Pick
that I've
one.
researched without knowing Palantir as well as you do. I mean, one I've done due diligence in and one I haven't. I don't think it's a fair comparison. I think that there's a deal to be said in for Square right now. And
So you would buy Square over Palantir, just confirming.
yeah, probably. I wouldn't put money into either one of them though.
I know if you have to, you pick Square
I'd
over
buy
Palantir.
PayPal.
Like, I can see where he's coming from. I own Palantir. I don't own Square for that matter. But by the same token, year to date, Palantir is up 170%. Square's down 35%. So
yeah, and one is growing at 13%. And the other one's like growing fast. So
well, the stock-based comp for Square is that's growing very fast. I understand.
I don't think you're in a place you're in a percentage of revenue. Palantir is much higher.
But Palantir's industry standard for SaaS companies like Snowflake, Databricks, they're all doing the same. So that's like a non sequitur. That's not even a good argument.
Palantir has also decreased their stock-based compensation
By 27.5%.
They decreased it along with their net dollar retention that they also decreased. So everything, they love decreasing.
along with their revenue growth.
Yeah, their revenue growth and their net dollar
We'll come back to this in a year.
The benchmark for SaaS.
We'll just see if a shape is doing better than an abstract philosophical understanding of the nature of existence, which is Palantir.
Ladies and gentlemen, welcome to the SoFi Weekly Podcast. SoFi's 1% IRA match.
I think this is great. It took them long enough to do it. I'm happy they did. And that's not a shot at them. They were working on a ton of other stuff. This is a really
it was
good
a pretty fast response. It was like,
well, Robinhood's been giving 3% on gold for like almost a year now. So it's not like it's whatever. But
no way it's been a year.
I think it's been like 6 months. But no, this is really good. Because the thing I've noticed, I don't have like a salary position. So I get 3% on Robinhood Gold, $5 a month on my 6,500 every year. As a freelancer, I guess, or an independent contractor, whatever you want to call me, there's millions of people like me. And to know that we have that option to get the same thing that people at like salary positions can get, or maybe even better than some of those people, that's really empowering to me. And I think SoFi is going to do the exact same thing for millions of people in the United States.
Do you think this is like a new race to the bottom?
Can you bring up Victor's comment?
It logs you into SoFi. You have to stay 5 years to get it, right? That could be the case. I honestly haven't seen that.
If that's the case, then that's really good, right? Because the longer that they can hold that money, then the 1% is negligible compared to what they can make off of that.
I don't see anything of that type. I just read through their frequently asked questions. It's not in there.
Steve, what are your thoughts on us 1% matching?
I have mixed thoughts on it. The bullish side is it should create crossovers with people moving their IRAs and Roth IRAs over, because look, you can't take out without penalty until I believe 59 and a half. I'd have to relook. Most people are locking this money up for 30, 40 years. If somebody's giving you 1% and another institution's giving you nothing over a 30-year period, if you're maxing out every year at 6,500, that would be roughly $1,950 you're getting for free. It may not seem like a lot, but why give up free money? So from that aspect, it could certainly lure people to open a IRA with SoFi the same way, even if you're not necessarily wanting to allocate money to a 401k or 403b, but your company offers a 1, 2, 3, or 4% match, you're at least going to probably do the 1, 2, 3, or 4% match to capitalize on getting the free money. So free money is always great for investors, especially with compounding. So there aren't many institutions that do this. So I think that that's very bullish, and especially for the younger generation that's just starting out. It really gets people inclined to start saving for their future. So I am all for it. The downside is if this really takes off, how much money are they paying out? So 1% every billion, it's a $10 million cost. If this spirals out of control, where you have a tremendous amount of money going in, that's a tremendous amount of money going out into deposits. So
yeah, potentially even up to 3% if we start really competing.
Yeah, well, but there's going to be unit economic positive on it. Like if they give out 10 million on a 1 billion, they're going to be making maybe 30 million or more. It's going to be positive from a unit economics perspective. They're not just going to lose money on this.
It's not a matter of losing money. It's about margins, though. You want to have fat margins.
And don't forget, this isn't deposits. I'm not a banker, but I'm not sure if they can utilize this to create investments. This is all stuff that's going into S&P or other stuff. This is just parking cash there. this isn't on their balance sheet as a deposit that can be used to loan out.
They do lend against securities, if I'm not mistaken, though.
I'll look at in the next quarterly earnings report and see if I can find it.
I think regardless, it was an important part of becoming the one-stop shop.
I like it. What other institutions do this?
SoFi, Robinhood, and
I'm not sure. I think some of the other players do. Like, does Vanguard not? But the only ones that I've seen is Robinhood, and they do it much better, 3 times better than us.
The way that company matches work is if you make X amount and you are putting in X amount, they're going to match, say, hypothetically, 3% or 4% of your salary up to that amount of you investing.
So let's just do an example for the sake of simplicity. Let's say I have a 100K salary. My employer does 6% matching. If I deposit 6,000, they will deposit up to 6,000, but no more than that.
They'll deposit 6,000, no more than 6,000. You have to deposit.
I have to deposit.
Unless they make an automatic contribution.
So if I deposit, let's say 3,000, and the employer only deposits 3,000, they match up to 6% of my salary.
That's why old industry professionals say if your company offers a match, at the very minimum, do up to the match because you're leaving free money on the table.
so this is good. This is great for SoFi.
Yeah, it's positive.
Lending Club reported preliminary earnings, essentially. They said they don't have exact numbers for their revenue and net incomes, but they said roughly what it's going to be. Lending Club aligns cost structure to evolving macroeconomic environment. What they said is that they laid off 14% of their employees, about 172 people. That's supposedly going to save them $30 to $35 million annually. That being said, they are only expecting in the third quarter $200 million in revenue. That's about 30 million lower than last quarter, and 4 to 5 million in net income is about half what they saw last quarter alone. They put this out today as a preliminary update. They aren't actually going to see their earnings results, I think, until about the first week in November. I don't actually know if they've put it out yet, but around that time.
I can't help but think SoFi had a part to play in Lending Club's downfall and their inevitable layoffs that they're now doing. We've seen the discrepancy between Lending Club and SoFi for like the last 4 quarters.
This stock was $125 in 2014. It's now $5.
Yeah, don't worry about the 2014 numbers. Worry about the more recent numbers. And worry about the stock being where it was just during
it's
COVID.
down 36% year to date. But like either Lending Club sucks just as a company when it comes to lending, or SoFi's actually eating their lunch, or the macro environment sucks and SoFi is going to take a hit.
Yeah, I don't know. Like, I don't think really they're touching each other's clients too much. I think that there's so many clients to go after from the big 4, which are, we can talk about Citigroup, Wells Fargo, JP Morgan. Deposits are going down. JP Morgan, I think, actually posted a little bit up, but they were acquired First Republic. So whenever excluding First Republic, they were actually still down like 7% or something year over year. With Lending Club, I just find like just culturally, no one uses, at least I haven't seen a single person that uses them for a checking account. It's very different. Like, I just think socially, SoFi has really hit a niche in a certain age group between 25 to 45.
I don't know much about Lending Club, but I don't think they're the brand that SoFi is.
Yeah, but yet they had more members than us at one point. They were like the first people to reach, I think it was like 4 million members, all doing like personal loans and everything. They were quite big, making more revenue than us. And then they started tipping off and they're going down, and they're saying they kind of did the same business that we did, offering loans for sale, personal loans, fully licensed chartered bank. They essentially look like similar businesses. And I honestly think that's why a lot of institutions are shorting SoFi. They look very similar, but one is performing extremely well and the other one's crapping the bed.
What's the short interest on SoFi now? Is it still?
I think it's 9%.
I think it's from 14%.
It's 14?
Yeah, it's 14 or 12%. It's something like that.
It was 11 leading up to the previous earnings. So I wonder if it's going to go up a little bit going into this earnings. It usually does.
You guys see the news on short selling today?
Very happy about that.
It's just disclosures. Like, hedge funds need to say the exact securities and when they're shorting a company, and it will be put out to the public on a monthly basis. Companies that are actually lending out those securities will also need to disclose that to FINRA as well.
So they're adopting a rule to increase transparency to short selling. And then every month, at the end of the month, you're going to have to disclose the specific stocks you're shorting. Now, I don't think the SEC is going to announce which hedge fund is doing it. They're going to aggregate the data and then announce it in
which is
general.
fine.
I heard that, but that kind of took away from, because they said they would aggregate it per security. But I'm like, I want it. I want to know who it is. That way I know to disregard an article or not.
I feel like they don't have the authority to do that.
Part of the reason why they're putting this out is because of market manipulation due to articles. Since at least 2021, the Justice Department and the SEC has also been investigating potential manipulation by short sellers and hedge funds around the publication of negative research reports. And you're not going to tell me who's shorting what?
That's insane. They can't control the media. They can't control articles. You would have to regulate the whole internet. That means every YouTube video would, like, you know what I mean? It's like,
How are they going to enforce this?
There is laws around pumping and dumping. No, they can't. They can't
yeah, but
regulate.
every article that's manipulating is not a pump and dump. It's just a perspective an individual has.
Exactly. And like, there's laws against pumping and dumping. Sure. Name one person that's gone to prison over the last, 3 years. They ask some tough questions to YouTubers and like Meet Kevin and shit. But like,
Yeah, but what about fines? Why are we talking prison time? What about that GameStop kitty guy? Didn't he face some pretty big fines for his YouTube videos?
I think he got away with
Did he
everything.
end up getting fined? I thought he got away. My point is, it's number one, hard to enforce, and number two, everybody gets away with that in positions of power. Like, yeah, obviously, if you're as blatant as a random guy on the internet making, crazy percentages on GameStop, from then until now, there's been so many people that have been just regularly shorting or manipulating the market, and nothing happens to them. It's just like their bite has no teeth.
PayPal's looking really attractive.
Yeah, I'm actually shocked where it is. I'm gonna have to buy more. I'm down on it. I'm gonna have to
I've been increasing my PayPal position actually a little aggressively.
Yeah?
Yeah, I've been buying it.
Let me see what my average is. Hold on.
I've been buying it heavy in my Roth too. Like I think it's Meta at 88, but Meta's high growth tech. That's why I can go up 300%. I think PayPal can get to 100 in the next year as long as things go well. But it's going to take time. It's definitely going to take time.
McKinsey and Company just recently put out a article talking about different financial institutions and how they ranked in total shareholder return over the last, I think it was like 6 years, from 2017 to 2023. And payment providers were the number one compounder for total shareholder returns.
How is that possible with PayPal and Block doing nothing?
Probably.
I'm just asking what other companies are considered. Is Visa?
No, it probably is those companies, but those companies have done extremely well for most of those years, aside from just this half of this year for the main part, last year as well. But like PayPal is doing extremely well for a very long time. And if you're looking at like a compounded annual growth rate, then they're probably just averaging it out.
They got bumped up to 126 too from JP Morgan.
It was Morgan Stanley or JP Morgan.
Didn't they hit like 52-week lows again?
Yep.
Yeah, I mean, it's the same price it was back in 2017.
Insane.
Kind of wild, bro. What do you say? Both analyst reports echoed each other on PayPal. They believe everything negative may be priced in Q4. Margin inflection is something market is ignoring. I was speaking to some bears today, and they were just like, "I don't use PayPal," and I was like, "I get it. That's like I don't use Facebook, but like that doesn't mean there's not other people that use it." But I get it. I don't know if that's enough of a bear case.
It's an economic story. It's a financial story. The bottom line is you're paying the same price as you were in 2017, and this is a company that's making billions in pure profit every year. They're buying back massive amounts of shares, and the EPS estimates are gangbusters. That's the most compelling thing.
BofA securities analyst Jason Kupferberg put a buy rating on PayPal today of $79, said that Q3 revenue risk is priced in.
Look at the EPS estimates. You have 44 analysts for 2023 and another 44 analysts for 2024. This isn't 3 or 4 analysts that are coming up with these projections, and then 23 into 2025. This is a very heavily covered stock on the street, and this is serious growth on EPS. I mean, this is a cash machine that has next to no debt. I mean, when you look at the balance sheet, they got 9.9 billion in on-hand liquidity. When you add long-term investments, which is anything that can be liquidated within a year, you got another 4.5 billion. Their long-term debt is 10.5 billion. I mean, they can, without even touching their long-term investments, they can pay 93, 94% of it off tomorrow without any forward earnings being interjected into it. I mean, this is a company that is a broken stock, in my opinion, not a broken company. That's what's making this so compelling at these levels. Full disclosure, my price per share is $60.92. And in the next week or two, I'm probably going to buy more to try to get that down to like the 58 level.
This stock hasn't been this low. I think it's like July
2017.
This is their buyback yield that I'm showing off right now. And as the stock has been plummeting, it's it's been allowing their buybacks to just increase like crazy.
They
Sorry?
have $2 billion being utilized for buybacks from the end of Q2 till the end of Q4. So we're going to see buybacks this quarter and buybacks next quarter. Or maybe they just shot their entire wad and freaking did it this quarter with prices where they are. But you got $2 billion of buybacks coming either this earnings report and next earnings.
Even in the last earnings call, they said July's branded checkout, which is the hallmark, like that's what you want. They said they expected higher than normal growth in July, and hopefully that has trended similar directions for the rest of Q3. I mean, from what I saw from website traffic, it has reached new highs. So I'm really excited. And now they're talking about going global with Braintree and doing the same method that has allowed them to gain a ton of market share in North America. Now they're going to go into Europe. It's like,
I don't want this to happen, but I would not be surprised if Visa or MasterCard acquires them or Apple. For the simple fact that right now the market cap is $62 billion. And this is a company that is expected to generate $5 billion in free cash flow this year. The unit economics works on the deal because of how profitable they are and where their market cap is now. Even if they get a 30% premium, you could at least get an offer because there's been way worse deals made for companies that make way less money.
No, the buybacks increasing, but the stock price decreasing means that, this is a massive red flag.
Well, there's more sellers than buyers.
PayPal didn't just start buying back shares now. They've been buying back shares for time. It's only increasing now in terms of buybacks because they're not doing acquisitions. They've been consistent with buybacks is my point.
And look, let's put this in perspective. PayPal is generating $5 billion a year in free cash flow. If they felt that there was a better opportunity to put that money somewhere else and make an acquisition or put it behind a different product, they would do that. They feel that they're generating the most value by buying back their shares because they feel their shares are that undervalued.
Artificially holding up the stock price. Yeah. But why? Because the stock price is going down, does that mean that my due diligence is any different than someone else's? Maybe they're wrong. Why? Because the stock price is falling. That just means that it's at a deeper discount. This could mean more alpha for me if I'm right and that the idea that PayPal is not dying tomorrow comes true.
I mean, look, the market is always right at the current price because that's what somebody is willing to buy it and somebody is willing to sell it at. But that doesn't mean that the stock can't go up or it can't go down in the future. It's bullish when a company's buying back shares.
So big banks did really well. Wells Fargo, Citigroup, and JPM reported today. Bank of America next Tuesday. All of them beat on pretty much every major thing they needed to beat on.
They all double beat, yeah.
Yeah, they all double beat. JP Morgan, the biggest thing for them is that their credit loss provisions, the market expected 2.5 billion. They came in at 1.35 billion, which suggests that maybe the whole credit tightening event people are thinking is inevitably going to come might not be as crazy as people think it's going to come. They lost 40 billion in deposits, which isn't that much for JP Morgan, but that does potentially show that money did go somewhere else, potentially SoFi. Revenue increased, net income increased. The market liked that the banks did well. The regionals were up today. Now, over the next 2 weeks, if the rest of the banks do well, then we might have a chance to have a reasonable Q3 earnings for the rest of the tech companies.
Yeah, and these are important, right? Because it's not like Morgan Stanley or Credit Suisse, or like these are commercial banks, the Wells Fargos, the Citis, the JP Morgans. They're more indicative of what we can expect from SoFi's bank side of their business.
The one thing that I think is so funny is I think people look at SoFi more like a lending club fintech than taking any sort of this news from the bigger banks.
Jesus.
Because they were all up and SoFi was down. I don't know. I just look at their consumer and community banks and I think their loans are up, deposits are down, but that's not going to be the same case for SoFi. We're going to see higher deposits. The one thing that I think is super cool is like their mobile only deposits went up at like the fastest rate that they've ever gone up. Like people are knowing how to bank online. That's becoming more frequent. And if you have an option and all the solutions become digital, why stick with someone that's going to give you 0.01% in a savings account? And we've already broken down the fact that SoFi or JP Morgan can't chase SoFi to the bottom of rates.
Citigroup looks even more undervalued than I thought it did last quarter. I mean, they continue to grow tangible book and book value. This company is trading at such a damn discount. It is crazy.
You have Citigroup, right, Steve?
Yeah.
Am I wrong?
Citigroup's tangible book value is $86 a share, and book value is $98.67 a share. Citigroup is trading at $41.43 with a 5.1% dividend. Crazy. Yeah, everybody says Citigroup, yet Berkshire bought
Whoa,
it, and
Overall, okay, here's the question. Do you think the big banks means that SoFi is going to do well for their earnings?
Yes. Net interest income is holding them up because obviously higher yields, and they're able to push that to the consumer, and our deposits will continue to go up. People are hungry for digital banking, and yeah, I don't see anything really too crazy this quarter that is negative SoFi. I mean, client assets for Citigroup, for JP Morgan, all these ones also came up, which is also positive for Robinhood as well. People are getting back into markets. There's still so much room to go. If you listen to BlackRock, they were saying like, you know, there's $7 trillion more that need to pile onto markets or pile back into markets. I'm really positive this quarter and going forward.
And in general, when the financial institutions do well, that means there's more economic stimulus going on, more loans are being given out, right? Obviously, there's nuance to it. But if they're not doing horrible, I think Q3 earnings is going to be pretty good for most companies, even if their stocks don't necessarily.
I want to see their originations so bad.
I want to see student loans.
Because look, we have a very high rate environment, 10-year lows for mortgages being taken out. And like Tannor said, I want to see what they're doing with student loans, even though it just came back on. I want to see if personal loans is staying at that level or if it drops off.
Yeah, student loan numbers are going to be big. They're going to be indicative. And obviously, as well, the sentiment on the earnings call, if they talk about just from an originations perspective to at least forecast out what we can expect for Q4 in terms of net new originations, that's going to help baseline us in terms of how confident we feel on that profitability estimate.
I even think from home loans, like all these banks showed off that like it was not strong in home loans. They all kind of decreased year over year and quarter over quarter. They've all had functioning home loan business. We're going from not having one to having one. You know what I mean? So there will be a lot of net new originations just because there were clients that wanted our services that we couldn't service before.
Mortgage applications are so low. I mean, that's not great by any means.
Yeah, no, I don't think that it's going to be a strong segment, but it wasn't a segment 2 quarters ago.
No, it wasn't. And next year, the CME, they got some interesting projections for the end of 2024. And the St. Louis Fed is projecting that we start cutting sometime in the middle of 2024. So that'll be bullish for the whole mortgage industry in general.
Do we think student loans is going to be more than 1.4 billion? I think that's what Chris said is the benchmark for us to get to.
I don't believe it.
Yeah,
I don't believe it. I'll be excited if we hit $1 billion. I'd be excited if we hit 800.
Really?
we're going to have a lot of originations to give out. And I think that we're probably going to focus still on personal loans.
That's super low on that estimate.
It's not super low. It's double what we did last quarter.
The environment's way different.
So this is the CME Group FedWatch tool, December 18, 2024 Fed meeting. I mean, you have, what is that? 60% is between 4 to 4.75. So they are projecting cutting some point next year, which is a long-term bullish trend for the mortgage industry. Just got to hold out another year.
Galileo Technologies was the first to attain a multi-market Mastercard certification in Latin America. We saw this week. Essentially, there's a program, Amit, you might remember this back in the day. SoFi got accepted into the Visa Ready program, which just sort of showcased to a lot of Visa clients that Galileo is a solution that will offer and does have solutions that are up to the capabilities that Visa thinks that is acceptable to be with their brand as a Visa Ready client. Well, MasterCard has a very similar product called MasterCard Engage, and SoFi has been named the first company to attain a multi-geography certification in Latin America that they can also offer through their, MasterCard directory. The actual thing of achieving this multi-market certification is good. The outcome of this, I mean, have we seen a single client from Visa Ready? Maybe. Is that how a lot of these clients are being found? No. No, I don't think so. Maybe in a more fintech environment like back in 2020 or 2021, sure, this is absolutely amazing. And I'm happy that we're here for whenever we go back into that style of a market. But in these high interest rate, low startup sort of zones where a lot of the big financial institutions are lying, like, no, we are not getting a top 10 financial institution to join Galileo Technologies or SoFi's technology platform through a MasterCard directory. It doesn't work that way.
Like, what does this even in real world do for us? because we already had the Latin American connection through Technisys. So if it was with regards to onboarding new clients onto the technology platform, like Technisys opened the door for us in Latin America.
This is not a real achievement. It's a certification. We passed a test. Like this is we have a plaque now. That's what this is. Essentially what this is doing is that if a client is looking through Mastercard to say, hey, I'm looking for payments, who's your best guy if I need someone in Argentina, Brazil, Chile, Peru, Uruguay? Galileo is the first person to have this achievement. Oh, okay, can you set us up? Yeah, here's their contact information.
Like super small. While we're on the technology platform, somebody posted this diagram around what an AI powered digital bank of the future would look like. This was a study done by McKinsey, and it was saying that an AI digital bank of the future has 4 layers: the engagement layer, the analytics decision making layer, the core technology and data layer, and then the operating model layer. So all of these are different technologies. You have blockchain in here, you have facial recognition, you have virtual agents and bots, you have natural language processing. And then obviously from the data layer, you have cybersecurity, you have banking as a service, you have modern API architecture, a lot of the stuff that Galileo is also doing. Basically, somebody commented on this saying that SoFi needs to start looking like this by 2025, or I'm out. And if you scroll down, you have Mr. Miguel Santos. He's the chief strategy officer for Galileo, founder of Technisys, commented. He says, we're already there. Many of them are in production and available for other financial institutions through Galileo. He continued to say that Connecta and PRP already leverage AI, and Cyberbank Core meets several features of this vision. Just interesting to see when you're looking at this wider vision of like, hey, where's that tech enablement platform going to go over the next several years? Every single week, I think for the last 3 or 4 SoFi weeklies, we've been talking about different pieces of news for Galileo. This certification is just the latest. Last week we had like Galileo buy now, pay later for SMBs. The week before that we had other news for Galileo. It's difficult to sometimes see what that big vision is, and then you look at diagrams or images like this. Everything in all of those layers sort of contributes to that wider vision of making Galileo this modern architecture that is the standard, the new standard for all the financial backend.
And I don't think necessarily compared to some other fintechs, but whenever you compare them to a lot of the older incumbent solutions, yeah, we are absolutely out of the game. And I think that there's a big, in the same article where they kind of took that image from the McKinsey, they were talking about how there's a big banking transformation going on right now. And AI plays a massive part of it. They think that AI is going to absolutely transfer banking on a legal perspective, on a risk perspective, on analytics side, on a customer facing side, marketing side. There's so many different ways that AI will play a part in this, and that hopefully Connecta is just the first signs of these. And we'll build things on the back end as well, things that you won't even really see. And I think that that's sort of starting to come in as well. You're seeing Citigroup and JP Morgan, these sorts of ones releasing like these blockchain tokenizing asset solutions for BlackRock, and people won't even hear about it. Like they're using blockchain, they won't even talk about it, but it's better for them for settlement times and costs and transparency and all of these things that are going to happen in banking, probably stronger than most industries. Where just decided to acquire a company the second
it would help if they don't have $1 billion
instantly.
of stock-based compensation. Even Palantir doesn't have $1 billion of, and
I wonder what it is on a revenue basis. Who has the higher stock-based compensation?
22% of revenues. Maybe Square's a little bit lower than that, but
Maybe
Palantir's industry standard for SaaS. I don't think Jack Dorsey cares about you guys.
you might even be correct in that.
To answer your question, Amit, Block has a stock-based compensation rate over the past 12 months of 5.78%. The difference is they lost $268 million in that period while paying $1.14 billion in stock-based compensation.
Wait, so they're not profitable?
No. Over the past decade, they have actually lost $765 million.
I think a little bit, it's just a difference in investing styles as well. I mean, honestly, I have not been in favor of Square. I've not been buying the dip. Things need to change. I think that there is some social aspects to Square that people need to understand how popular this app really is. And that will differentiate the way that
Okay,
Steve reads a balance sheet.
No,
Looking at
there's
block.
only one way to read a balance sheet. There's only one way to read an income statement. This is a company that makes $19.7 billion in revenue and they can't generate a GAAP profit.
I'm not happy with them. They recently just did another acquisition that I'm not happy with.
Dude, they gave $300 million to Jay-Z for title.
Before Tanner's acquisition, he's going to talk about, they had $5.87 billion. They have more than enough cash to fund the operations. So it's not like this company's in trouble. It's just a shame that they're now monetizing their business into profitability.
I think that's the way fintech works, though. I think it's customer acquisition, and then once they're there, they're so sticky
Dude,
that
Cash
you
App
can.
has been the #1 app for like 10 years on the finance store. I'm exaggerating, but like, what do you mean? They're acquiring tons of customers. That like they have the user base.
I think that monetization will come. They can get into personal lending and all these things that you don't agree with.
We've had this conversation before. Tanner's whole argument is like, oh, I'm investing in future growth and user acquisition and adoption is the biggest metric. And then on the other side, you're like, yeah, but they're low value, low switching cost users. It doesn't take you anything to open a Cash App and a Venmo and a whatever else. So Tanner, Square or Palantir?
Tanner, don't make the wrong decision.
Dude,
Don't make the wrong
don't.
decision.
Please don't.
Because I will clip this and I will post it on my Twitter. Do not make the wrong decision, Tanner.
Do not make the wrong
Do
decision.
not say the wrong thing.
Like on a 12-month basis
For a year, for 1 year.
For 1 year, okay.
I don't know. It's hard. I don't
have to
think
make a
this is
decision.
not
Pick
something that I've
one.
researched without knowing Palantir as well as you do. I mean, one I've done due diligence in and one I haven't. I don't think it's a fair comparison. I think that there's a deal to be said in for Square right now. And
So you would buy Square over Palantir, just confirming.
yeah, probably. I wouldn't put money into either one of them though.
I know if you have to, you pick Square
I'd
over
buy
Palantir.
PayPal.
Like I can see where he's coming from. I own Palantir. I don't own Square for that matter. But by the same token, year to date, Palantir is up 170%. Square's down 35%. So
Yeah, and one is growing at 13%, and the other one's like growing fast. So,
Well, the stock-based comp for Square is definitely that's growing very fast. I understand.
I don't think you're in a place. You're in a percentage of revenues. Palantir is much higher.
But Palantir's industry standard for SaaS companies like Snowflake, Databricks, they're all doing the same. So that's like a non sequitur. That's not even a good argument.
Palantir has also decreased their stock-based compensation
By
for the past
27.5%.
They decreased it along with their net dollar
8 or
retention that they
9
also decreased. So
quarters.
everything they love decreasing.
along with their revenue growth.
Yeah, their revenue growth and their net dollar
We'll come back to this in
retention,
a year.
which is
and
the
we'll see what's-
benchmark for SaaS.
We'll just see if a shape is doing better than an abstract philosophical understanding of the nature of existence, which is Palantir.
Thank you guys
All right,
so
guys.
much for watching. Appreciate your time. Bye for now.
See you guys later. Bye, everybody.
Bye.